Hi, welcome everyone to today's CSIA business webinar, When the Number Matters, Understanding and Maximizing the Value of Your System Integration Business. My name is Colin Hammond and I will be your host today. For those of you who are unfamiliar with CSIA, we are a global nonprofit professional association with over 500 member companies in 40 countries. Our mission is to advance the practice of control system integration to benefit our members and their clients. Our vision is to ensure that manufacturing and process industries everywhere have access to low-risk, safe, and successful application of automation technology. CSIA membership offers members access to resources needed to attain and exceed business goals. To highlight just a few of our many member benefits, the CSIA Best Practices Manual guides control system integration companies in the setup and running of a solid company. CSIA's Business Insurance Program offers members an excellent insurance program for business owners, subcontractors, and more. The program includes members from all over the world enjoying the peace of mind that comes with CSIA insurance. Clients in all industries are now seeking integrators with a CSIA certification alongside ISO. They recognize CSIA certified integrators' commitment to industry standards and business acumen. As a result, being certified can shorten the sales cycle. CSIA Industrial Automation Exchange is the premier automation guide featuring system integrators and suppliers who provide industrial, manufacturing, and process automation solutions. For integrators and suppliers, it's a place to market their expertise. Clients will find white papers, case studies, capabilities, contact information, and engage in conversation directly with CSIA members. Please follow CSIA's online events calendar for all upcoming webinars, including both partner webinars and business webinars. CSIA's business webinars feature topics handpicked by CSIA leadership to help you run your business. CSIA's partner webinars are opportunities given to CSIA's industry partners to address hot topics and demonstrate their expertise. You won't want to miss these opportunities to learn from the comfort of your own home or office. For more information about CSIA, please visit our website or contact us at info@staff.controlsys.org or 847-686-2245. And at this time, I would like to introduce our presenter, Kathy Durham. Catherine Durham is president of Capital Valuations Group, a 45-year-old firm that helps business owners understand, increase, and unlock the value of their businesses. For more than 25 years, Kathy has worked with business owners and advisors to determine the value of an equity interest in a business, identify ways to increase value, prepare for transitioning out of ownership, resolve owner disputes, family and non-family, and define valuation provisions of buy-sell agreements that are unambiguous. Kathy earned her MBA from the University of Wisconsin-Madison and has earned the accredited senior analyst designation from the American Society of Appraisers. Recently, she has engaged in developing a web-based tool called Business Trend Analysis for business owners and advisors to help them understand and use the company's historical financial data to manage their investment more successfully. Kathy writes and teaches nationally on topics related to business value and serves or has served as a director on a number of for-profit and non-profit board of directors. And with that, I will now turn it over to our distinguished presenter. Welcome, Kathy.
Thank you very much, Colin. Good morning, webinar attendees from the sunny Madison, Wisconsin. Over the past 7 years, I've had the opportunity to attend various CSIA conferences, sometimes to teach and other times just to attend. It's a great organization with members that really are very smart and also very fun. So getting to know and work with many of you has been one of the highlights of my career, truly. So thank you for taking the time this morning to attend a webinar. The hard part as a teacher about webinars is that you can't read people's faces and you can't tell, are they understanding or am I going too quickly or whatever. So if you wouldn't mind, please do feel free to type in a message. I think on your screen you have a chat area that you can type a question into, or even to say repeat that, or I didn't understand that. I'm here to help you understand a very important concept that you don't think about every day, which is what is the value of your business. So we'll get into it today, and I'm hoping to, not just hoping, I plan to make it worth your while, and I plan to do that as soon as I can figure out my control here. It's not going forward. Colin, can you help me with that?
Sure, no problem.
It's always better when you take my picture off the screen. All right, so today, we are going to be talking about several key topics that I think are not regularly understood in the business world, and why would they be? You are busy each day doing what you do best, and I don't really understand all the technical things about what you do as system integrators. Similarly, I've been valuing closely held businesses for 25 years, and the question that I continue to hear from business owners is, where do I begin? What is this valuation thing about? So just that you're attending to learn about that is very helpful. So we'll be talking about determining whether your business is transferable or saleable. Now, what I mean by that is that whether you're a service business, as you all are and our firm is, or if you're a manufacturer, there is we all start with a balance sheet, right? We start with assets. Your assets might be computers and desks and people. For a manufacturer, it might be equipment and plant, et cetera. And so we start, though, with this balance sheet of assets and liabilities, not so that our business doesn't grow from that. Our plan, our goal, every business owner's goal is to use that balance sheet to generate goodwill or cash flows that make the business more valuable than just if you turned out the lights and sold your assets and paid off your liabilities. So when I say we'll determine is your business transferable or saleable, what I really mean is it likely that your business is generating economic benefit that you would receive more than the value of liquidation? Any of us could come to work and decide that we are going to stop doing what we do and in a reasonable way sell our assets and pay off our liabilities. But is there value above and beyond that? And in most of the system integrators that we've seen, and frankly most businesses, that's why we're in business, is to generate value above and beyond just our tangible assets. The second area that we'll cover is understanding why every business has more than one value. And you may scratch your head and say, why does that really matter? It matters in a tremendous way because it will help you to prepare eventually, whether you are 30 years old or you are 75 years old, you will transition ownership of your business. And if you can understand why there are various values to your business, you'll be able to drive value. And then lastly, today we're going to get into understanding how is a business valued. And just by understanding how a valuation is prepared helps you to identify ways that you can, even today, go back to your business and figure out how to be able to increase value in your business. All right, so I'm not sure why it won't forward. Colin?
Yep, I can do that for you.
Maybe it's here. All right. No. All right.
So if you double click on the slide on the bottom, it'll move it with the arrow. There you go.
Oh, got it. Double clicking. Sorry about that. All right. You technology people are probably giggling at this valuation person who can't forward the slides. Well, I wanted to start because I find with some demographics. I think that these demographics are extraordinary, and we are literally seeing it happening right before us. When I say the boom is on, I'm referring to the baby boomers who were born between 1946 and 1964. And there are a lot of us. I am one of them. And in fact, we were very entrepreneurial. And what it's doing is it is creating, as any of us, we'd have to be having our head in the sand to not hear about the different implications that is having on us societally. And so what it's doing is creating this very large lump of business ownership that is going to have to change, whether people die owning their business ownership, which is a real messy way to do it, or planning to be able to, many of us are asset rich and cash poor. We own a business that's successful. How do we convert that successful business into our retirement? So just looking at the numbers just very quickly, by the way, one that's not on here is that I was interested in how many publicly traded companies there are in the United States right now. There are approximately 3,300 publicly traded companies. And yet everything we hear about is about publicly traded companies because that information is readily available. And so we're tuning in today to the value of a privately held or closely held business ownership interest. So if you counted all of the businesses that are organized in terms of filing for a legal structure in the United States, there are 27 million. But if you narrow that down to just those who have employees, because those are the businesses really that are more saleable or transferable, and we'll get to that in a minute. But 70% of those 12 million businesses are owned by baby boomers. So that is why there is going to be, and it has already begun, a tremendous amount of transition from either owner to children, owner to other family members, owner to employees, or to other outside buyers. And so without a doubt, because of just their ages, the boomers right now are aged between 55 and 73 years old. It is happening, and it's estimated that peak in those transactions will be 2022, although it has been bumping out further and further because it turns out baby boomers also don't want to stop working. So in any event, I thought that was kind of an interesting way to frame. You have plenty of company if the reason why you joined this call today was so that you could understand maybe how to start that transition process. All right, and so if we move on from there. So why does it matter to you what the value of your business is? And I'd have to say that it's astounding to me that all of us most likely invest in a 401k plan or an IRA of some sort. Can you imagine going 30 years and getting the statement of the level of your accounts in your 401k or your IRA and just not even opening it, not opening the email, or just shredding the envelope and never looking at for 30 years what is the value of your investment? And yet, your business is most often, by far, the most valuable asset that we own, and yet people don't know the value of their business. So how can understanding the value of your business help you? It first allows you to gain a realistic understanding of the current value of your business. What's interesting is before we deliver our conclusion for every client that we work with, and we value approximately 80 businesses each year, before we sit down with them to share our conclusion of value, we ask them to write down on a piece of paper what they think the value of their business is. And I can, with stats, tell you that over 95% of them believe their business is worth more than it actually is. So better to understand before you are able to make a big decision like, am I going to retire? Am I going to transition out of my ownership? It's important to understand a realistic value for your business. Then along the way, having a business valued allows you to develop strategies for increasing value, and value can absolutely be increased, but it does take time. So it isn't something that you can do overnight. Being able to implement tax-saving strategies, because you can figure out then the terms of the transaction as you understand if this is the value of my business. You then work with an accountant to understand how much of that will I be able to actually have to spend and use in my retirement, and how much of it is flexible if I just can flex with how I receive the payments. And then lastly, identifying who might your buyer be. And we're going to look at a chart that we created to just help you to understand that there are different buyers for a business, and it really does impact the value. And how do you get in front of the buyer that you're most interested in? It isn't always a competitor. So the very first thing that we do when we start a valuation is to first cross that hurdle of, do you have a transferable business or a saleable business? Again, one that generates cash flows above and beyond just liquidation value, where there would be goodwill or an amount paid to you because of other things that are not reflected on your balance sheet. So many people, and it can appear to be very, very successful, that I have a very nice looking business and drive a nice car and live in a nice home. It doesn't necessarily mean that my business is transferable. So how do we determine that? Fortunately, it's easy, and you can do it right now, which is to ask yourself 2 questions. Is your business so dependent on you, it's most often the owner, or a specific individual, that should you not be able to come to work tomorrow or forever in the future, the business would end. It would not continue. Now, any business that loses a key person hiccups and struggles while they get their feet underneath them again. But this is a different question. This is, are you one of those owners that has all the key relationships, that the customers only know your face and want to talk to you? Do you keep all financial information and the processes in your business such that others don't really have that delegated to them, and they have to come to you to solve their problems or to get answers to questions? So this is really, if this is a factor in your business, the idea is to delegate, 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 which, by the way, from what I can tell, and it's true of me as well, that does not come naturally to baby boomers. So we do like to be in control, and we do like to be the problem solvers, and we've worked hard to build the businesses that we have, and that ownership of being the information keeper is sometimes difficult to give up. If indeed the business is not so dependent on you or a key individual, move to the next question. Does your business generate sufficient cash flow for both market compensation and return on investment? So it is not atypical for us to climb inside of usually smaller business than many of the system integrators we see, but there's confusion between whether you are an employee or an investor in your business, and you are both. Any of us could quit today, sell our business ownership interest, and go work for a competitor. So what would be your market compensation for doing what you do technically as a system integrator, not as an owner? What would you be paid? And does your business pay you at least that amount, or at least is it able to? If it doesn't pay you that, is there sufficient profit at the end that you could adjust it and still have profitability? Because many times a business owner will say, well, my profits, yes, I'm profitable. I had $60,000 of profit last year. all right? And how much of your compensation is up in the expenses? Well, my compensation is that $60,000. No, it's not. So you wear two hats. And today we're talking about the hat of you as an investor. So it's really adjusting your income statement to market compensation levels, and many of you overcompensate yourself, which actually gets adjusted in valuation so that you get the benefit of that excess cash because it's cash flows that really drive value. So if you can look at these and say the business is not dependent on me, I've done a great job of delegating, I can leave my business for 2 weeks and it runs just fine. And number two, yes, my business is profitable, even after paying market levels of compensation. Then you do have a transferable business, and you do have a reason to have a valuation done. So the very first thing when we go to do a valuation then would be to define what it is we are being asked to do. Now, there are a lot of words on this, and they're frankly words that you can read later. The goal here is to identify who are different potential buyers of your business and which buyers are willing to pay less or willing to pay as you climb up the graph, who is willing, what group of buyers is willing to pay more for a business interest. And this is true across the board. It's not just system integrators. So we created this chart to really help business owners to think through for themselves, who are these buyers in my world? Where we see most system integration businesses selling is in this area here, 4, 5, and 6, which would mean selling to your employees, whether that's an insider management group, an outside group that's in your area or in your area of expertise, or selling to an ESOP, an employee stock ownership plan. Down here, 1, 2, and 3, this would be a passive investor. This is where, for the most part, most private equity, investment bankers, this is saying that if you were to sell your business to, say, somebody like Kathy Durham, who doesn't work in your business, doesn't understand your industry, I'm just investing my dollar because I think I can get a good return on it, or a better return than I could with alternative investments. Therefore, I don't work in the business, don't understand it. That means I have increased risk. And if you have increased risk in a business, you are going to have a lower value. And I think the only takeaway down here, most of you would not be interested in selling to these buyers. But if any of you have gone through a divorce or go through a divorce, or you're going to gift ownership interest to somebody, or you die owning an interest in a business, we are instructed through case law and the IRS that it is the lowest enterprise value or business value. It is buyer number 1 that we are instructed to use when we are valuing for the purpose of divorce, estate tax, or gift tax. So do not have a valuation done for one of those purposes and then assume that that's an appraisal that would work really well to then talk to a competitor or to somebody who's going to be willing to pay more for your business. So the employee groups, as we move up here, as I mentioned, who are the primary buyers of, or the most often, the most frequent buyers of closely held business interests, particularly in the system integration world, they do work in the business. They likely do understand the processes. They have ideas of what they'd like to do with it. They have client relationships, and so they have less risk. And therefore value it goes up because the cost of capital or the discount rate, which we'll talk about in just a minute, is going to be lower because of the risk being lower, and that means value is higher. And as you move up, we all think about who are our competitors, but they're only number 7. Now, a competitor, once we start at level 7 and move up, value can increase significantly because we not only reduce risk, but we also could increase cash flows because there may well be duplicative expenses or expenses that are no longer needed because you're combining businesses. Diversifying businesses, though, number 8 is an important one for you to think about. That's if you can think of those people in your world that you buy from or sell to. Would they be interested in adding what you bring to the chain, to the supply chain and the service? Would they be interested in adding your skills, your employees, your reputation to what they do and capture that profit center? So it's important to think about who you buy from or who you sell to for that area. And number 9 is the strategically positioned business buyer, where there is most likely consolidation going on. So where there's consolidation is where there is sometimes, crazy money, we say, far higher than the value of the business offered, because through the consolidation, the big companies that are buying, or any company that's buying, is looking to get the best companies that they can. And many times that means they have to raise their price, what they're willing to actually pay, and price and value are different. All right, so the buyer's chart. Think about who these people are in your world and make sure that they know about you if you are interested in selling to them. So what is value? I mean, we really start from the premise that value is quite a simple mathematical exercise, really, that it is talking about what are the future economic benefits or cash flows. What is a buyer willing to pay for your business is based on the cash flows that your business will generate in the future. Very important, future, that word. Because if I'm a buyer of your business, I'm not going to get my return based on your financial accounting, your past. Financial accounting, GAAP accounting, is a very necessary exercise in the world of owning a business. It is not, however, how you value a business. So value is forward-looking, and it's about the economic benefits that will likely be generated, discounted back to the date of valuation, or here we're saying it's today, using a discount rate that says what is the risk of me getting those cash flows, actually achieving those, and what are the other qualitative factors about the particular closely held business that I'm looking at, and what would I be willing to pay for that because it reduces risk or increases risk. So in a nutshell today, from here forward, this is what we're going to be focusing on, is then how is that quantified? Unfortunately, there is a serious misconception in the business world that frankly trickles down from the publicly traded marketplace, where one company within an industry is very similar to another one because of how large they are, because of how public their information is, so shared best practices, because of geographic diversity as well as management depth that's rather extraordinary, such that there is this world that says, if you could just give me your income statement, I can look at your earnings or your revenues, and by earnings I'm looking at the net income line on this slide, and I get to this magic word EBITDA or EBITDA or all kinds of ways of saying it. It's an acronym that stands for earnings before income tax, interest, depreciation, and amortization. So what it's trying to do is to estimate what are the cash flows that would be generated from you doing your business, because the income statement is a very good summary of your sales and then all of your expenses and your net income, but net income is sometimes impacted by some non-cash things like depreciation and amortization. Interest and tax are added back because any buyer has their own unique tax level, and their decision whether they have debt or not impacts the interest. So it's kind of like, what would be the cash flows that would be available to somebody who's looking at the business and just assuming that that year of EBITDA, 428, almost 429,000, is going to continue every year, not just next year, but into perpetuity. So when you take EBITDA and apply a multiple of 5, you are basically saying that you would expect your business to have that same EBITDA number every year into the future. And unfortunately, while that is a projection, it is a very messy projection because A, it's missing some very important areas of cash flow that are going to be required by the business. And it also ignores the fact that a business is changing, that it is a closely held business that is gaining contracts, losing contracts, hiring, firing, possibly moving locations, expanding locations. And if you forget as a buyer that those things are going on, you could very well make a huge mistake buying a business that ends up needing a lot more cash than what you thought was going to be needed. So what I hope to do is by the end of this presentation or webinar today that you will leave knowing that taking any multiple, explain to me even what does that multiple of 5 mean, or 4 or 7. It doesn't give you the opportunity to negotiate with anyone because it's just a number that doesn't have a lot of basis, and it's the wrong level of cash flows. So a multiple of EBITDA I would love to see go away. Here's why. Let's assume that we've got 2 companies that are in the identical industry, and the only difference between them would be these factors, which we see regularly in the businesses that we climb inside of to value. There are about 15 of these, by the way. These are the qualitative factors in a business that many of you work to make better every day, whether your turnover is high or low. Do you have customer concentration issues where 46% of your revenues come from one customer as compared to a much lower number? Our rule of thumb is if you have a single customer that represents 10% or more of your total revenues, that increases risk. And if you hear me say increasing risk, that means discount rate increases, value goes down. If you have contracts or no contracts in place, if you have room to grow before you have to expand, or if you do not have room to grow and you cannot do any more growth in revenues without investing in new facilities or renting more space. Do you have contracts with suppliers, or do you have any concentration issues with your suppliers that you're very dependent on one or more? And then what's the competitive environment that you exist in? It could be very different from another one. Now ask yourself, of these, what are these 6 factors? There are approximately 15 factors just like this, that where are these reflected on your income statement in that number that we were just looking back here at with EBITDA? None of those factors are reflected there. And the problem is that they get reflected, and we'll see where they get reflected in the discount rate in a little bit. We'll get there. So it's not about EBITDA, and this slide also has a fair amount of numbers on it, and the key here, though, is that we start with EBITDA. Let's assume you're buying businesses, that you are growing by buying businesses. Now, this example is much larger than the typical business that we see, frankly, but this company, and this is a repeat of a valuation that we did, just copying it correct right out of there, that their EBITDA was $13 million, and if you apply a multiple of that, you're going to pay X. And then as soon as you own the business, you're going to find out that this business is growing like crazy, and that in 2016, they needed $19 million. And again, very large numbers because it happened to be a very large company. It's still true of the system integration businesses that we climb inside of that have EBITDA of $3 to $50 million, that you still end up having to ask, if you are a growing business, you are going to need cash to feed your working capital. This means the business grew tremendously in 2016, and they have to fund their receivables and their inventory. Whereas in 2017, growth slowed down, and their business actually generated working capital cash flows. So where does this, and it's real cash that's needed for funding this or getting back in your pocket, totally gets ignored when you stop at EBITDA. So then you come down, and the other line that most often gets missed is line 4 about reinvesting in capital expenditures. If you're buying a business and they have every year that they're investing $1 million. Now, system integration businesses, you're like us somewhat, that you have less usually in reinvestment in capital expenditures. We're not manufacturers, but that doesn't mean that you don't have capital expenditures in vehicles, I don't know if you capitalize some software, some computers, furniture, facilities, leasehold improvements, those kinds of things. If you miss them, they also require cash. And so these two factors alone have a significant impact on what would be the cash flows that are left over for me to have in my pocket to be able to get a return on my investment. And so it's just a really important thing that all factors get considered. And that change in working capital, that's why we hear that a business can be growing like crazy and go bankrupt because they can't fund their receivables and their inventory because they're offering terms to their clients and not getting cash in the door right away through receivables. So if we don't value a business by applying a multiple of EBITDA, what is the way then that we should do this? And I have a question here, and I'm going to jump in and see if I can answer it, just so this is by capital expenditures, not capital as cash. Would this be true of a low capital business like professional services? So back to that point, the way to look is to just look back at the last 3 years for your particular business. What have you invested in capital expenditures historically? And then more importantly, are you a company that in the future, say in 2020, you're going to replace vehicles for your company, or you're going to buy into a system, a computer system that will integrate all of your accounting and your sales channel? It's just saying be sure you're looking and including any future capital expenditures, any items that are purchased and then capitalized. Because if you buy a business, and there are many system integration businesses, by the way, that are buying other system integration businesses, you want to understand how capital intensive is that business. It certainly is less intensive than a manufacturer or somebody that has a lot of equipment and tangible assets. So when we do look at the right way to value a business, it does look just like when we value our homes. If we ask a real estate appraiser to value our home, they rely almost solely on the market approach because there are just tremendous databases that are very detailed about bedrooms and bathrooms and air conditioning and garage, etc. So those databases drive how they value a home. Unfortunately, we don't have that kind of specific data on closely held businesses. We do have growing databases, and we subscribe to them, and we always go and look, but it is assuming that every system integration business is just like all the others. And I've climbed inside of enough of them now to know that you are all very different from each other, whether it is management depth, location, number of locations, what industries do you sell into? That is a huge one. Are you in the oil and gas? Are you in water treatment? Are you in animal food or pharma? The industries that you serve have a huge impact on what it is that you do and how you do it. So it's dangerous to assume that because you're all in the same SIC code or NACIS code that you are all the same. So the market approach also ignores things like it's really capturing price. It's capturing what did a business sell for. And that also includes the negotiations that went back and forth. What were the motivations of buyer and seller? What were the terms of the deal? If I'm willing to accept, or if I'm willing to pay all cash at date of transfer, I may transfer my business at a lower price just because I don't have the risk of having to finance part of the deal. None of that gets disclosed in the market data. So it certainly gives us data points. We always go there and we include that, but it's not really done there. That's not how business appraisers value the closely held business. The asset approach would say we're going out of business. We're going to liquidate. It's a lights out value. So it says it's a focus on the balance sheet. It is not a going concern value. It's saying if we were to reasonably sell our business by turning out the lights and ending it, let's sell our assets, collect our receivables, sell our inventory, pay our liabilities, what would we have left to put in our pocket? This we rarely use because we're almost always asked to value a continuing business, but it is one of the approaches that's considered. Business valuation really happens in the income approach, and I don't think you'd find a business appraiser out there that would disagree with that. And it's because what it does is it focuses on the specific business, your business, and what is the story of the numbers behind your business. So your revenues, your expenses, and it's modeling what will those likely be in the future and discounting those back to arrive at the cash flows relating to your operating plan, not just every system integration business. So if we just take a quick look at the asset and the market approach, I only wanted to sit at the asset approach for just a second to say it is all about the balance sheet. It is not about anything other than liquidation value. It says here's your balance sheet as reported, and you do adjust for things like accounts receivable, are they all collectible? Inventory, is it all saleable? Here they bought land, and they also have a facility, a building, and it's very important to keep track of the fact that those go on your balance sheet at its original cost. So if you bought that land in 1980 for $250,000, it stays on your balance sheet at that purchase price until it's sold. So you don't ever want to just look at your net equity here and assume that's what you'd have if you have land and buildings. You would need to have an appraisal done, and you would need to adjust those to market value, hopefully having appreciated over time. So that's the only thing to be careful of when you look at net asset value or the asset approach. This is what we look at and say this is a floor of value. This is the minimum that you should be able to get for your business, assuming that your receivables, that you can actually liquidate all of these and that you've restated them to a market value. Not very useful to the ongoing business, though. So the market approach, as I said, and I don't think we need to spend much time here now because I think I've explained, we literally go into the databases and get a sheet that looks just like this, and that it lists the various companies and very little information about them, frankly. It's all purely quantitative. This business sold for a multiple of this times revenues, a multiple of this times EBITDA or assets. It's purely quantitative about others that are in the same industry code. Years ago, it used to be trying to get data from the publicly traded marketplace. As you can imagine, it's very difficult to find anything there that is comparable. The key there is it comparable? So then we get into the income approach. And the income approach only has two methods. The first method is the capitalization of historical earnings. And that's really saying, let's look back at how the company has performed, and let's take a shortcut. We don't need to prepare the future operating plan and the financial outcome of that plan because we're valuing a business that is mature. In other words, it's a business that looks very similar to how it has performed in the past. They don't have significant change in their horizon, not in revenues and not in their expenses. Frankly, in the times that we value a business, we're lucky if we can use that methodology one time in a year of valuations, because most businesses are growing or shrinking, they're hiring or firing, etc. So most often, the discounted cash flow method is what is required. And again, the capitalization of historical earnings is just intended to be a shortcut for this one when it applies. Unfortunately, we see this one being used almost all of the time by accountants. And because it's a very quick and easy way, and I'll show you how it's done. It is an accepted methodology, but only if the business expects no change in the future beyond inflationary growth from price increases, no real growth. So let's just take a look at that capitalization of earnings. So it's, again, intended to be a shortcut only when the company is mature. And it's interesting that many times I'll hear bankers say, but I like doing that method because it's based on real historical numbers and it's not a projection. It is a projection. It is the most simple of projections, and it's basically, as we looked at before when we were talking about a multiple of EBITDA, this is basically that same thing. A multiple is just the inverse of this capitalization, which I'll better explain here in just a second. But it is a projection that your business will basically never change. So the key problem really is that we've got to look into the future, not the past, because change is part of most businesses as they go forward. So the discounted cash flow method is just more detailed. It does take more time to do it, but it can look into the future, and it can incorporate assumptions that happen in year 2 or 3 or 4. Let's say that you know you're going to expand your facilities, but it isn't going to be until 2021. Gee, if I'm going to value the business, I need to understand what will the impact of that be on the cash flows. And let's say you don't own the building, it's just a third party that you're renting from, your rent's going to go up. How do you incorporate that if you just say, I'm going to look back at the past? It also gives you more detailed cash flows and looks at all levels of cash flows, not only the cash flows from operations, but after capital expenditures and after working capital, which we hinted at as being the shortcoming of just stopping with EBITDA. So why is the capitalization of historical earnings overused? It's because it's simple. I need 2 numbers in a calculator, and I can be done in a very short period of time, because the numerator is a single number that's intended to represent the future earnings of your business forever. So again, it would be like saying that your EBITDA is the number that you would use right there. And the denominator is what we call this rate of return, or the discount rate. And there's the most confusion about what that number should be. It is not 20% for every business or 25%. I have seen them in my career vary from 15% to 65% for a business that's an ongoing concern. And what we're trying to get at, what is this why? It's like saying, if I had $1 to invest in the bond market, I would expect to get 3 to 5% if the government's not messing around with it. If I put my dollar in the stock market, I would expect to get 8 to 9% over the long haul. If I invest my dollar in real estate, I would expect to get 10 to 12% over time. So what we're trying to answer here, and I'll show you how we answer that, is what rate of return would I need to invest in the business that's being valued, in your business? And that number can vary significantly, as I said, from 15 to 65% as a rate of return to make it worth the investing in that particular business. So if we look at the numerator, those cash flows, the X that we were looking for, we start, as we do with the discounted cash flow, by looking and summarizing your historical reported income statement and balance sheet. So here, again, lots of numbers. We don't need to care about what they all are individually. I would assume you all recognize an income statement as reported would be your year end. We typically look back 5 years, sometimes longer, if the business cycle says there are significant downturns or upturns, increases that make it more not so consistent. And then we usually take and adjust the most recent year, and we include adjustments for such things as market compensation, market rent, and non-recurring items. This might also be where we would adjust for such things as personal expenses if they're run through the business, which we encourage not doing, but sometimes that is the case. So we have a normalized figure, and right there we have our numerator, our cash flows. But again, we're only talking about EBITDA because we're only on the income statement. So that also is something that needs to be factored in and is not when we look at the capitalization of historical earnings. So how do we develop that discount rate or that rate of return? Well, we're stuck with looking at alternative investments. You could put your money in the bond market. You could put your money in the stock market. And this is a number, this equity risk premium, that is tracked every single year since the formal beginning of the stock market in 1926. And this is a look-it-up number. If you've got the same date of valuation, this is just saying what have investors in the publicly traded market required as a rate of return above the risk-free rate as of the date of your valuation. So if you do a line there, it's 9.73. So it's that, again, the rate of return from the stock market. But we know that your industry is more or less volatile. So this is the entire stock market. Then we can dial down into the industry. We can dial down into the size premium. So size is a huge factor, and as you can see, it adds almost 10 percentage points because smaller is riskier. And again, each of these numbers that are in black are looked up. And so our judgment is not included in any of those first four figures. It's only in the one that's in red, the specific company risk factor. And that's where, A, you have the most ability to increase the value of your business. We all know growing revenues increases the value. But what about what reduces risk? So in our world, we have the ability to judge what will this number be, the specific company risk factor. And I'll show you some of those factors that go into that. That number can vary from 1, it can actually vary from 0, to as much as again, many, if you're looking at angel investing, they'll be up there in the 50 percentiles because it's really saying how risky is the business beyond the cash flows that we've measured. You add these up, and what this is saying is $1 invested in this business would require a rate of return that's nearly 26%. We reduce it by long-term growth because what that does is it assumes it's an inflationary growth factor. It assumes only growing at inflation, raising prices only for what you sell, but your costs will also go up by that amount to arrive at a cap rate. That's how we get to our denominator. So all I need to do is divide the denominator into the numerator, and I quote, have a conclusion of a mathematical equation. It is not reflective of the value of your business if your business is changing. It also, those specific company risk factors, that number can go up as a positive or down as a negative number based on these factors. Management depth in your business. Are you a brand new business or are you established, have a nice reputation, and your processes are documented? Do you have concentration risk in in customers or in vendors? Is your competitive risk growing or decreasing? Technology risk, are you just investing in new technology or do you stay current with your technology? The culture of a company reflected many times by turnover of your employees and the rate of turnover. Do you have environmental risk, litigation risk, if there's an ongoing litigation risk? Many businesses have that, and it's not a big thing, but it certainly is risky if it's not settled yet. International risk. Many of you, I know, work in the international marketplace, so currency risk, let alone tariffs and other such things that can really impact a business. your reputation risk, positive or negative, warranty risk. If it can't be quantified, it definitely is something that's out there. So at least discussing it and being able to incorporate that in any business that you're looking at to buy, or you will be looked at those things if a buyer is looking at you. So these are those softer qualitative factors to focus on to increase value in your business, and they go into that specific company risk factor. So all I wanted to show you in this slide is what's the difference. A discounted cash flow method is not just a fraction. It's taking that same year, that normalized year, and then we talk with the business owner to say, where do you see growth happening? Well, in this business, look at their growth rate. It certainly isn't inflationary only. This is a real numbers, again, of a company that got awarded a contract, but the revenues won't hit their books. The work won't begin until 2020. And so we're able to project that growth in that year. Also, though, they are going here, they like this industry that they got this contract in, and they're going to hire a salesperson who's going to focus on just being able to grow that marketplace. So they know that not in 2020, but in 2021, they have plans to hire a salesperson. So the expenses increased as well as the payroll taxes in order to then continue the growth going forward. So they want to stop this negative growth and instead be able to regain and continue to grow into that market. It's also about gross profit margin and being able to say, is your gross profit margin able to increase? If you can increase your gross profit margin by 1 percentage point, it has a huge impact on value. So we talk through, what do you know about the future of your business? Is it going to play out just like this? Absolutely not. But that's why you have such a significant discount rate when you're valuing a closely held business as compared to a publicly traded business. Because all of this data, I put this slide up again, these first 4 factors come from the publicly traded marketplace. So when we discount your cash flows based on publicly traded discount rate, we end up at a level of value that's as though you're publicly traded, which means it's a minority value conclusion, and it can be recognized in 3 days. So in other words, you could sell your business interest in 3 days and get your cash if you invest in a publicly traded stock. And we all know, wouldn't we love to be able to come in and say, I'd like to liquidate my ownership interest in my business and get my cash in 3 days. Not possible. So this whole level of value, the conclusion, when you apply a multiple to EBITDA or you capitalize historical earnings, where are you in terms of the levels of control? First of all, if I'm valuing a controlling interest, you own 100% of your business, I need to apply a premium for control. And every business has a discount for lack of marketability because we know it takes longer than 3 days to sell our business. So very important to ask that question, what level of value are we at, and are we missing discounts or premiums? So just to remember that in the world of business valuation, control versus minority is a very different exercise, and it's very important to not assume that if you own 100% or 51% or more, you own control, and that is worth a lot because you have control over operations. We'll go to the next slide. You have operating control where you control all the day-to-day operating decisions. You have financial control. You can decide if the company will have debt or not, and if so, how much. You have executive control in that you can identify a board member. You can decide to put a board in place, a board of directors for the business, or get rid of a board of directors. You can decide to divest of a segment of your business or buy a business. These areas of control are very valuable. And so you don't value a controlling interest, 100% of the business, and then say that a 10% owner would get a pro rata 10% of that value, because there needs to be more significant discounting that happens in a minority interest block of ownership because they don't have these controls. And so my next to the last slide is just stating this idea of value versus price. We all hear at parties or in your conferences or your meetings, you'll hear about somebody who sold their business for X dollars or some multiple of. That is price. That is after negotiation. That's after the terms of the deal have been negotiated. We help out with this piece, with value. And I put this fulcrum here to say that as soon as you know the value of your business, and then you go to negotiate a deal, a transaction, that one, either the seller or the buyer always has a better position. So if I'm the seller and I'm not in a hurry to sell my business, but you as the buyer are in a hurry to get my customers, my geographic footprint, my industry that I sell into, or my employees, we're starting to see businesses buying each other just for the employees that are in place, then I'm motivated as a buyer to increase what I'm offering to you because I'm more motivated to buy than you are to sell. If you are diagnosed with something difficult or you're burnt out and you wait to the last minute to sell your business, this fulcrum will go the other way, and the buyer will recognize that you want out more than they need to get in, and the price that's offered and finally settled on will be less. So just remember this, that it's no different than with our publicly traded stocks that we say, buy low and sell high. When your business is doing well is the time to transition out of ownership. And we're only talking about ownership. If what you love is the work you do, you can still continue to go to work and have a very nice employment contract. We're talking here today about the ownership piece of it only. And the reason, the last slide is to say that, as Warren Buffett very wisely said, if you don't know the value of your company, any buyer will steal it from you and not have to look back and ask why they got it for such a deal. But if you know the value of your company and you can justify it, and that's where multiples fall apart, is that you can't justify it. Whereas if you've built a plan that reflects your business plan going forward, you can support why is the value of your business what it is. And Warren Buffett and I think others would be perfectly happy to pay every nickel of it. So what time is it? I am 4 minutes late. I'm embarrassed, and you guys are still engaged here. Thank you for that. Are there questions that I could answer? I don't see any others other than the first one that I answered about capital-intensive businesses. So does anybody else have any other questions? Otherwise, sincerely, we are here. We're a phone call or an email away, and we're a resource. It doesn't cost anything to call and ask a question or to explain your situation and ask, what should I do next? So seeing no questions, I'm going to hand it back to Colin, and thank you each for attending and being interested in what I think is a pretty interesting topic, the value of your company.
Thank you, Kathy. Let's see if we can give them a minute here, see if we get any questions coming up.
Any questions? There is no such thing as a stupid question. All right. Well, thank you. And give me a call if you'd rather ask it in private or send me an email. Happy to be here and happy to be part of the CSIA.
Okay, so on behalf of CSIA, I would like to thank Kathy for this informative discussion. I'd also like to thank all of those attending. We hope you found this webinar informational. When you close out of the webinar, a link will pop up to a brief evaluation. We would appreciate it if you would take a moment to share any and all feedback with us. We'd also like to remind you that a recording of this webinar will be available for viewing within 30 days of this event. It should be quicker than that, and we'll have it up on the website. Please visit the CSIA website to view this recording or a past webinar that you may have missed. And this concludes our program for today. Once again, thank you for joining us, and have a good day. Thank you again, Kathy.
Thank you very much.